Textbooks call market makers liquidity providers. In reality, they are the opposite, holders of reverse fragility. They thrive in calm and vanish in chaos. Dissects the mechanics of adverse selection, using the November 2025 COMEX Silver episode as a case study. The textbook story is simple: market makers post bid and ask quotes, providing liquidity and smoothing price moves. But that is a fair weather description. In reality, a market maker is a dealer who buys when you sell and sells when you buy, earning the spread. That spread is their compensation for holding inventory risk. When markets are calm, that risk is small, and the spread is easy money. When markets turn violent, that risk explodes, and the spread no longer compensates for the danger. The textbook ignores the asymmetry. Market makers are not obligated to stay, they are rational agents who optimize their own survival. So the first lesson is, liquidity provision is a business, not a public service. Let's formalize the market maker's dilemma. Their expected profit per trade is the half spread, S/2, minus the expected loss from adverse selection. Adverse selection means the counterparty knows something you do not, or the market is moving against your quote. If the expected adverse selection loss, L, exceeds the half spread, the market maker loses money on every trade. In that moment, the rational action is to widen the spread or withdraw. This is the core mechanism behind the umbrella in sunshine behavior. In November 2025, COMEX silver futures experienced a violent one-way rally. The price surged, and the market maker community, which had been short volatility and short inventory, was caught off guard. The first sign of trouble was the breakdown of the futures spot basis. Normally, futures and spot prices move together, but in a squeeze, the basis widens dramatically, and the hedging relationship that market makers rely on fails. The second sign was inventory accumulation. Market makers were forced to hold large short positions, and as the price kept rising, their floating losses mounted. The third sign was model failure. Their pricing algorithms were calibrated to normal volatility, so they could not keep up with the actual price moves. The result was a classic liquidity vacuum. This chart shows the trajectory of COMEX silver futures during the episode. The price moved from around $30 to over $50 in a matter of weeks, a move that was unprecedented in magnitude. The vertical line marks the peak, after which the price collapsed. The key point is the speed and size of the move. It was far outside the range that any normal volatility model would have predicted. That is why market makers' algorithms failed, and why they had to pull their quotes. The chart is a visual reminder that market makers are not built for tail events. Adverse selection is the hidden tax on market makers. When a market maker posts a bid, they are essentially offering to buy from anyone who wants to sell. In normal times, sellers are a mix of informed and uninformed traders, and the market maker can average out the losses. But in a crisis, the sellers are predominantly informed. They know something the market maker does not, or they are reacting to the same information faster. The market maker's bid becomes a magnet for bad trades. The same logic applies to their ask. The result is that the market maker is systematically on the wrong side of the trade. This is the rain that makes the umbrella useless. We can quantify adverse selection loss. Suppose the true value of the asset is V, and the market maker has quoted a bid of B. The expected loss when someone sells to them is the difference between the true value and the bid, but only if the seller is informed. If the probability of an informed trade is P, and the average information advantage is delta, then the expected loss is P times delta. The market maker must set the spread wide enough to cover this loss. In a crisis, P and delta both rise, so the required spread widens dramatically. When the spread exceeds what the market will bear, the market maker simply stops quoting. Not all market makers are the same. The key difference is whether they have a mandatory quote obligation. Voluntary market makers, like most quantitative arbitrageurs, can exit whenever they want. They are the umbrella in sunshine, present when it is profitable, absent when it is not. Obligatory market makers, such as those introduced on China's COMEX board, are contractually required to maintain continuous quotes, even in stressed conditions. They provide the liquidity that the market needs in a crash, but they bear the risk that voluntary players avoid. This distinction is crucial for regulators and investors alike. Regulators face a fundamental trade-off. If they impose strict quote obligations, they ensure liquidity in crashes, but they also impose costs on market makers, which may reduce their willingness to participate in the first place. If they allow voluntary exit, they get efficiency in calm times but face liquidity vacuums in crises. The silver episode showed the cost of voluntary exit. At the peak of the squeeze, the market was effectively one-sided, with no one willing to take the other side. This is why some exchanges have introduced market maker programs with incentives, such as reduced fees or rebates, to encourage continuous quoting. But incentives are not obligations, and they may not be enough in a true panic. Let's model the cost of an obligatory quote. The market maker's expected profit per period is the spread revenue minus the adverse selection loss, minus the cost of capital for the inventory they must hold. If the obligation forces them to quote even when L is high, their expected profit can turn negative. The regulator must set the spread, or provide subsidies, to keep the market maker viable. The formula shows the trade-off: a wider spread reduces the loss but hurts the market's liquidity. The optimal spread balances these forces. This bar chart illustrates how bid-ask spreads widen during stress. In normal times, the spread might be 1 or 2 ticks. During the silver episode, spreads widened to tens of ticks, and in some moments, there were no quotes at all. The bars show the average spread in different phases: calm, early stress, peak crisis, and recovery. The widening is a direct consequence of the adverse selection loss increasing. The market maker is not being greedy, they are trying to survive. The chart is a stark reminder that liquidity is not a constant, it is a variable that disappears exactly when you need it. Let's put some numbers on the table. During the peak of the November 2025 squeeze, silver futures moved more than 10% in a single session, and the basis between futures and spot expanded to levels not seen in years. The open interest in short positions reached record highs, and the cost of rolling those positions spiked. These numbers are not just statistics, they are the mechanics of the market maker's pain. They show why the algorithms failed and why the quotes disappeared. For investors, the silver episode is a warning. When you see a market moving violently, do not assume that liquidity will be there when you want to exit. The market maker's withdrawal is rational, but it is also predictable. You can protect yourself by using limit orders instead of market orders, by diversifying across venues, and by avoiding crowded trades. More importantly, understand that the market safety net is not a guarantee. It is a business decision made by rational actors. The next time someone tells you that market makers provide liquidity, remember the umbrella: it is only there in the sunshine. Market makers are the umbrella that vanishes in the rain. They provide liquidity when it is profitable, and they withdraw when it becomes dangerous. The November 2025 silver episode is a perfect case study of adverse selection in action. Understanding this mechanism is essential for anyone who trades, invests, or regulates markets. The next time you see a market in turmoil, do not expect the market maker to save you. Instead, be prepared. We read them all. Markets reward discipline, not certainty. If this analysis helped, like the video and subscribe to DeepQuant. Tell us in the comments which market idea we should test next. Evidence beats noise. Control risk before chasing returns.